So consolidated financial statements, 4 standards that we are going to be referring to in the series when it comes to dealing with consolidated financial statements. And that is IFRS 3, business combination, IFRS 10, consolidated financial statement, IAS 28, investment in associate, and IFRS 11, joint arrangement. So these are the 4 standards that we are going to be trying as much as possible to make references to as we try to look at this whole topic of consolidated financial statements. In our discussion, we are going to be looking at 5 key issues generally in my presentation, 5 key issues. So my presentation will take on the character of 5 key issues, which will be the tone for the discussion. Number 1, we're going to be looking at the concept of control, how we can obtain control, and how we apply the IFRS 10 and IFRS 3 treatment. Number 2, we're going to be looking at significant influence using equity accounting and also applying IAS 28, investment in associate. Number 3, we're going to be discussing the concept of goodwill. If we are doing consolidation, how do we calculate goodwill? How do we deal with fair value of consideration transfer? We will come to that. The 4th thing is going to be non-controlling interest, which was previously referred to as minority interest, but now referred to as the non-controlling interest. And we'll look at how we value non-controlling interest, but most importantly, also look at the treatment of impairment in goodwill. Then we're going to be topping the icing on the cake generally with the treatment of intra-group trading. So that is how our presentation is going to be taken under this consolidated financial statement masterclass. Like I said, my goal is to be able to help you to understand the principles and get the easy marks when it comes to dealing with the consolidated financial statement generally at the end of the day. Now, the concept about consolidated financial statement comes in because an entity seeking to expand and grow would want to make investments. Now, when it comes to making investment, an entity may decide the level of investment that it wants to make in the entity in question. The first level is to try to test the waters, and that is making equity investment. Now, the first level is equity investment without any control or significant influence. So this kind of investment, we are just buying shares in the company, but we don't have control. We don't have significant influence in the entity. We are just buying a company or some shares of the company. For such kind of investments where we don't have control, we don't have significant influence, like we discussed under IFRS 9, they will be accounted for as financial assets in accordance with IFRS 9, financial instrument recognition and measurement. And we spoke about how we deal with that. That's not what we are looking at in consolidated financial statement. But like I brought it up in IFRS 9, it is important to bring it up today here. The second level is where the business wants to really make some serious investments. So the entity can, on a second level, make an equity investment, but this time around, the entity would want to gain what we call significant influence. So with significant influence. So if the entity is making the investment to gain significant influence, what does that mean? In a simple language, we say that significant influence is simply the power to participate in the financial and operation policies of the company. So significant influence is the power to, let me use the word right, to participate in the operating and financial decisions, or if you want, policies of the entity. That is what significant influence is about generally. If the entity has significant influence, that means that we are going to be applying IAS 28, investment in associate. Okay, we're going to be applying investment in associate, and not just any application, but usually we're going to be carrying the asset using equity accounting, or carrying the asset in the books of the investor under equity accounting. So here, the carrying amount of the investment shall be in accordance with equity accounting as per IAS 28. Now, if we are going to then apply the equity accounting, how then do we deal with that? Pretty simple. So we're going to have the cost of the investment coming up. We're going to be bringing in our share of post-acquisition profit or loss. Share of post-acquisition profit or loss. If it is a loss, we're going to be subtracting. If it is a profit, we're going to be deducting. Any dividend received will be deducted. Will be deducted from the investments, the carrying amount of the investment. Next, some investment may suffer impairment. Okay, like what Andrew asked yesterday about impairment in financial assets. Some investment may suffer impairment. So we bought a business, we bought some shares in a business, then the shares suffer impairment. The whole business suffers impairment. So our share value goes up. So we are going to be bringing our share of impairment, our share of impairment in investments in associate. In associates, we're going to be deducting it. You got to be mindful of this because it is just our share we are bringing. And this is impairment in investment in associates. There is impairment in goodwill. We'll come to that later, but this is impairment in the investment in associates. Our share will be brought there. Then if there is any intragroup trading, that is the associates sold to their parents, we're going to be dealing with intragroup trading later on. So I'm going to come back to that in a moment. Just stay with me. But if it happens that the associate sells to the parents, then we have to look at the implication of the provision for unrealized profit in there. So associate sold to parents. Don't worry, I'm going to come back to this under intragroup trading. For now, just get a pro forma and know what is going to be building up in the discussion. So once we are done with that, this becomes the carrying amount at the reporting date. That will go on the face of the statement of financial position under non-current asset, because investment in associate is a non-current asset. Note that it is the share of profit from investment in associate that goes to the P&L and not the dividend received. It is the share of profit or loss from the associate that is recognized in the consolidated statement of profit or loss and not the dividend received. These are principles. And like I keep on telling you always, everything in financial reporting, corporate reporting, is about principles. So just like how when we are dealing with financial instruments, it is not the interest payable or interest receivable that we bring in the P&L, but instead the finance income or finance cost based on the effective rate that is brought in P&L. When we are doing investment in associate, it is not the dividend that is brought on the face of the consolidated profit or loss. Instead, it is a share of profit. What does that mean? Just like how we did the adjustment when we're doing the financial instrument, if in a given question, there is a note that the dividend received from the associate has been included in the income of the parent, then we have to remove the dividend, but rather bring in the share of profit from the associate. That's very important. That is very, very important. And that is the idea about applying equity accounting on our second type of investment when we get significant influence. So the question we ask ourselves is, what are the things which will indicate that we have a significant influence? What are the things that will indicate? So I'm going to be going back into my slide. Those of you with the book, you'll be able to see this in the consolidated financial statement chapter, and you'll be able to see it there. So number one, factors that are indicative of significant influence. Technically, the primary issue about significant influence, technically, is when we are acquiring maybe above 25%, but below 50% of the shares of the company. That's the default way in that particular case. So anything above 25%, it's likely to give us significant influence, but then below 50%, because immediately we cross 50, we are getting into control. So, but it depends on the context of the question, because sometimes we may even have just 10% of the company, but because of the way the deal is structured, it could still be treated as IAS 28 investment in associates and not IFRS 9 financial instruments, financial assets. So it depends on the context of the question, but by default, any investment that is going to be above 25 but below 50 is going to give us significant influence. But beyond that default, there are other things that can indicate that we have significant influence. One, representation on the board of directors or equivalent governing body of the company. So when we have a representation on the board, remember, we don't control the board. It is not about having the majority of people sitting on the board. We have a representation. By virtue of the fact that we have a representation on the board, it is a significant influence. Because if you go and buy shares right now in MTN, you're not going to have a representation on the board. That is why your investment in MTN will be treated as IFRS 9 financial asset, and you can carry it through P&L or through OCI. But when you make investment in MTN and that investment gives you the right to have a representation on the board, even if it is one person or two, that is a sign of significant influence. Because of the representation on the board, it means we participate in the policy making process, especially when it comes to dividend and other distributions. That can also be an indication of significant influence. So like we said, we are having 25% or more, but below 50%, or we have a representation on the board, or like the main definition that we gave earlier, we participate in the operating and financial decisions or policies of the company. Any of these scenarios will give us significant influence. And that is the second type of investment that we make as a company.